Hey everyone, welcome back to the show. It's St. Patrick's Day this week, celebrated at least in the US, so I've got on the hat. And it's the first day of spring, celebrated also, especially in my region where gets a little bit cold in the winter months, and we're looking forward to it getting a lot warmer. So, a lot has gone on since our last show. This coronavirus or COVID 19 virus has really not been good for anything around the world. It's changed the world as we know it a lot. Communities have been affected, families have been affected, people have passed away or become severely ill. Financially, it's not a good story for the stock market and many financial avenues around the world. Part of it speculation when it comes to the stock market, and part of it is now reality when it comes to investing in some of these public companies as well. Things like the people in the travel industry, cruise ships, airlines have really come to a halt or really severely slowed down. Your local restaurants and stores and things have closed or are shuttering their hours as well. Really hoping that things get back to normal, communities can be healed, people can be healed, and things can get back to better than they were before. For those that do have investments in the stock market, I know you've seen the losses. The S&P 500, thought to be an indice or indicator of the overall stock market, as you learned in show 1 or 2. It's down as much as 25%, which is just unfathomable, unbelievable, especially year to date, and really especially just over the last 2 weeks down that much. So there's nothing you can do about that now, really. Those losses are those losses, and you probably just ride it out and wait for it to recover. And it will, based on path, health pandemics, or crises. I don't know if we've seen anything have this much of an impact that I recall or could find, but I think it will recover as it has in the past. But it'll take some time, no doubt about that. So nothing you can do about it now, but just ride it out and allow it to recover and get those gains back that have been lost here in the last 12 or 14 days. Keep in mind in the future, though, or if you do decide for some reason to sell and move your investments to cash and into your own pockets, just to hold on to or to invest elsewhere, consider real estate. Consider what you have learned here so far, what you're going to learn today, and what you're going to learn and what this show will bring to you in the future. Use this education. In fact, that's what this show is for everyone, to take action, not just to listen and learn, but to listen, learn, take this education and take action to do something with the knowledge you're gaining here. So consider an investment in real estate. It is not as volatile as you've seen in the shows we've had thus far. Never, not that I ever recall, has real estate taken a 25% loss overall in just 2 weeks. So strongly consider it, and let's learn some more today. In today's show, we're going to continue with real estate investing. In the last show, we had an introduction into real estate investing, and today we're going to continue to talk more about real estate investing, diving much deeper into the buy and hold avenue of real estate investing. So let's go ahead and get started, and looking forward to sharing this information with you. So here's some of the things we're going to start to talk about with real estate investing. But as we start, let me give a disclaimer about real estate investing, especially buy and hold. It is not a get-rich-quick type of thing. It's not an overnight wealth type of thing. It is a long-term wealth-building avenue or direction you can take to build wealth. Now, there are some parts of real estate investing that are maybe get rich quick or get rich quicker, meaning faster or quicker than your earned income job, a job you might go to every day. Those things would be fix and flips and wholesaling, but those are jobs in themselves. Those are, as I started to say before in the prior shows, those are typically for the active investor, typically require a lot of time. So I'll say those are, again, jobs in themselves. So the power of real estate comes from the wealth that can be built while you're doing something else. So I'll say that again. The power of real estate comes from the wealth that can be gained while you're doing something else. So whether you're working on a different project in real estate or you're doing something together all totally different, such as your career, job, or something else, the power of real estate is still at work building wealth for you, even when your mind or your thoughts or your activities are not related to real estate. So when you think of debt, first thing that comes to my mind is usually credit card debt. Maybe to your mind too, maybe, but we'll say credit card debt, and maybe you don't think that it's all bad. Maybe you have necessities, or you have things or emergencies that come up and you have to purchase or procure, buy something, and you have a credit card for that reason. Let's just say bad debt is bad credit card spending, unruly credit card spending. And let's say a car, you do owe, maybe if you don't buy the car outright cash, you will owe someone debt on the car until it's paid off. But you do need to get to and from, so maybe you don't think of that as bad debt either. Misused home equity loans and lines of credit. So if you do a refinance on your home, if you have equity in it and you own the home or are trying to own it, you have a mortgage on it, you may be able to get cash out, and maybe it's up to you what you do with that cash. But I would say bad use of that would be to go out and buy things that you don't need. So that would be a bad use of a home equity loan or line of credit, and so on. We probably can think of all types of things that you can go out and rack up a lot of debt on: credit card, cars, badly used home equity loans and lines of credit, again, so on. We're going to call debt, for this conversation, debt you repay out of pocket, or what I'm going to term a liability. So something that you buy and now you have to keep paying on it, and it's money out of your pocket. So that kind of summarizes everything. So we won't get into how much credit card is bad, how many or what type of cards are bad debt, and etc. But let's just say any type of debt you have to repay out of pocket, or what I would call a liability, means that's bad debt. Good debt. Let's say, and this is debatable too, again, all these things, whether it's an emergency or not, if you have something you got to repay at the end, it's still a liability, no matter what the reason was you had to buy it. But we'll just say, for the sake of conversation, maybe, again, necessities. Maybe you use a credit card or a loan for necessities. If you don't have cash, maybe you have emergencies that come up. Maybe you have home equity that you do a home equity loan or line of credit. You take that cash that the bank gives you, and you maybe use that to lower other debt. Maybe the interest rate, for example, on a secured loan, secured to your home, would be lower than like credit card interest rates. So you're talking 3, 4, 5, 6% on a home equity loan versus 12, 13, 14, 15, 25% on a credit card. So maybe that's a good idea to use that home equity loan or line of credit to pay off other debt or to buy assets. So what's an asset? I'm going to say an asset is something that puts money in your pocket. If liability or bad debt is something that takes money out of your pocket, we're going to say an asset is something that puts money into your pocket. So good debt. What is good debt? If these things above are, maybe it's debatable. I think if you pay for something and you have a balance left over, you got to repay someone. No matter what, I just think that, you could still term that as a bad debt. It's a liability. You're going to be owing whatever that balance or whatever that is until you pay it off. So good debt. I would say, as I've shown here, good debt is something that pays for itself and maybe more. Now, I never really heard of good debt, but as I looked further into investing, especially real estate investing, I learned, and that's why I want to share with you, that there is something called good debt. So how do you create good debt? You say that's good, so how do you create it? Well, you use the debt to buy assets. And assets are worth value. Assets, again, put money into your pocket. Assets can typically be converted to cash. So an example, as we get into real estate here with buy and hold real estate investing, if you use debt to purchase a property and you receive income for the rent or lease on that property, and the income from that lease or rent pays for the debt and maybe a little bit more, that would be good debt. That would make your purchase an asset and not a liability, because you can walk away and you can go do something else, and that property or that asset is being paid for. That debt is being covered by the asset. Now you'll recall that I said that the asset produces income, and that income pays off the debt that was used to acquire the asset or the property, in this case of real estate, and it pays a little bit more. So the income from the asset pays the debt and a little bit more. So what's the little bit more? Well, that's the cash flow. That's your profit. That's your return on your investment. It's all the above. Now we're going to get to cash flow in just a minute, but let's talk a little bit more about good debt. Good debt is used in real estate all the time. It's used in the form of leverage. At least that's what it's called. So you use leverage many times. If you own your home, or you're trying to own your home and you have a mortgage, when you first acquired that home, you went to the bank, you filled out an application, they did all their vetting and backgrounds and credit checks and all that. But at the end of the day, you had to show up to the closing table with 5, 10, 15, 20%, maybe more if you so chose or if the bank required. So you put that down, and in return, you were able to move into the home and continue to pay the bank the rest over time, maybe in the form of 10, 15, 20, 25, 30-year mortgage typically. That's leverage. So your home is real estate, and you can use that exact same scenario to acquire real estate investments or to invest in real estate. This is another example of the power of real estate really flexing its muscles. You see, if you wanted to invest your dollars in the stock market, and I know I keep comparing real estate to the stock market, that's only because the stock market is a popular place for people to invest. And there's pros and cons to that, like we talked. We won't go back into that, but I'm here to show you an alternative investment that gets away from some of those cons and maybe has a few more pros. But anyhow, if you wanted to invest in the stock market, if you needed or wanted to invest $10,000 or $1,000 or $50,000, $100,000 maybe in the stock market, you need the entire $100,000 or the entire $50,000 or the entire $10,000. With real estate, if we think back to that scenario when you acquired your home, if you acquired it or you have a mortgage or you're buying your home, you only need the part that the bank is not going to pay. So you only need the equity or the part you're going to put as a down payment. So you just need that 5, 10, 15, 20, 25, 30% maybe down, and you're able to acquire that real estate. So let me explain that again. If you wanted to invest in the stock market, let's say $50,000, there's some high price stocks out there. You need the entire $50,000. If you want to invest in real estate, let's say $500,000 in real estate, you don't need $500,000. You only need 20%. We'll be conservative. We'll say we only need 25 to 30%. So if you wanted to buy or control $500,000 in real estate at 25%, you only need to come up with $125,000. Now to compare that to other investments, if you want to invest $500,000, someone or that something's going to expect you to come up with $500,000. So again, that's the power of real estate investing. Sometimes maybe thought as a high barrier of entry, but compared to other investments, it's a low barrier of entry or low capital outlay or low money you need to invest to control such a large asset. So what am I doing here? I decided to invest in real estate. I show with my investment, my percent to put into the investment opportunity. I've got my 25% or whatever the investment requires. What am I doing here? What am I getting? So remember, you're investing in an asset. Real estate is special because it's an asset you're investing in. So what did I say? That asset puts dollars in your pocket. So you're investing in an income stream. So you put your investment into the asset pays You, the investor or investors, the asset pays the bank, and then there's some left over. That left over is cash flow. That's income or money in your pocket, a long income stream. So you're no longer trading time for money. You're trading your investment for a long income stream. Some say you should buy things in assets. So what does that mean? So instead of taking $50,000 and buying a car or buying a boat or some large thing, maybe you take that $50,000, invest in an asset that pays for that thing. So you take the $50,000, you invest in an asset, or whatever the amount is, you invest in that asset. It pays an income stream that then pays for whatever it is you were trying to purchase in the first place. So you take the $50,000 or whatever it is that you're investing, you put that into the asset. The asset, again, puts money into your pocket via an income stream, and you use that income stream to buy whatever it is you want to buy. So it pays for the car, it pays for the boat, it pays for your child's education, whatever it might be. And by the way, after the asset pays for that thing you wanted to purchase, it just keeps on paying. So it'll pay for that thing over and over again, or it'll just be more cash into your pocket or more income into your pocket that you can do whatever you want with, or live off of, or maybe put back into another investment. It's a circle. It's a really good circle. And I'm hoping the light bulb's starting to go on for you on how some of these things can work, or how things should work. And if it's not clicking for you yet, don't worry, it will. So Chris, you've talked about percents. So yeah, I've talked about percents, and we started these shows or these episodes with savings account percents and inflation percent, and what their percents or returns look like on different types of investments. What does that all mean? What are these percents like representative of? So I was asked like what the difference is with these percents. What does all that mean? You hear about annual percentage, interest and rates and those type of things. So what does that mean? So types of returns or your interest on anything, credit cards or loans or savings accounts, typically it's measured per annual period, so per year, and we'll keep the same thing here. All that really summarizes into, for me, we're going to call it return on investment, or ROI, you may hear a lot of. So that's the return on investment in a year, in a year's period. So if we look at these examples here, this is just the math behind it. We looked at the math before, but we're going to look at the math in a different way. And it's a really simple formula. So I got 3 examples here. The first we looked at was, if you recall back to some of the earlier episodes, 0.10% was what a savings account gave you in terms of a return on investment. Well, that's really low, no matter what you're counting, whether it's pennies or millions of dollars. 0.10% is a very low percent of anything. And the reason why, again, if we think back to some of the earlier episodes, I believe it was episode 1, when we looked up the definition of a savings account, it didn't sound like a savings account was going to give us a return just by definition. It sounded like you put money there, and when you came back, you expected it to be about the same way it was before. And if we look at this is exactly what we see. Example 1, we see that if we started with $1,000, when we came back a year later, it was $1,001, which equals 0.10%. So the formula is simply at the end of 1 year, the new value of your money, or the balance in that account or that investment, minus what you initially had there, in this case $1,000, divided by that initial investment, gives you the percent back in terms of your return on investment. So if at the end of 1 year, 1 year's period, you have $1,000, and when you started the year, you put $1,000 in there. When you came back, it equaled 0.10%. Let's go up in numbers. So this is kind of equivalent to inflation, the 2% here. So example 2. So if you started with $50,000 and the new value came back after 1 year, $51,000, if we divide that by that original value, we come up with 0.02 or 2%. Now we look at like investing. Typically investing should give you more of a return. Example 2 was inflation. So inflation is going to be about 2%. This is the representation of things going up in price over over a year's time. So those goods, everyday goods and services that you buy, food and transportation, those type of things that go up each year. So example 2 is a good example. I related this to your paycheck, hopefully, and you'll want this from your employer. Hopefully your employer is giving you at least a 2% raise. So if your salary, using these same numbers, was $50,000, the next year, hopefully it is at least $51,000 or greater, because if so, that raise won't be a raise. It'll be a loss, because the things that you used your salary for will have, some of those things will have gone up in price. So if you're not getting at least 2% at your employer, that's concerning, because you're actually working a little bit for a loss, because those things you buy, again, with your paycheck, your salary, food and transportation, those type of things, those things are going to go up and your income's going to stay the same. So let's get on to example 3. This is a representation of 8% return on income. Again, return on income meaning the amount that you come back to after a year. So if you start the year with $50,000, we come back after 1 year's time and it's $54,000, that's 8%. That's a nice number. So that's something you can't get in a savings account. It's greater than inflation, so you're doing good there. So you have more money than the cost of things over that year's time, so that's a good thing. So $54,000 being the new value, $50,000 being the original value. We divide that by the original value. We come up with 0.08 or 8%. So we want to stay away from here, the savings account area, and it's okay to save. You should have some money set aside in cash, but don't think that this is the key to long-term retirement or long-term wealth gaining or generational wealth for years to come. Because already inflation, things are going to go up at least 2%. And if you're only saving at 0.10%, that's not enough. You're falling behind. And then if we look at our investments, this is where you start to see the difference between $54,000 and $51,000 year over year over year over year. The difference between 2% and 8% or a higher return really starts to build wealth for you. And that cash flow is what equals this 8%. Okay, so more math for you. Now the math in real estate doesn't get any more complicated than this. Adding and subtracting, multiplication, and division. It doesn't get much more complicated than that. There's some percents in there, as you just saw, but it doesn't get much more complicated than this. You can handle this, right? I'm sure you can. And a handy calculator along the way will do wonders as well if you can't. So don't worry, the math doesn't get much more complicated than what we have here. So cash flow. I talked about cash flow most of this entire show. So income minus expenses equals cash flow in any business. And as we talk about real estate business, it's similar. Income minus expenses equals cash flow. So what is income? So typically in we'll say a residential format, such as a single family home or an apartment building, or really any type of tenant landlord or tenant investor relationship, what the tenant pays, whether it's a person in a home or a person in an apartment building or a business in a retail store or office setting, the rent or what they pay for the lease monthly or quarterly or periodically, whatever it's agreed upon, that's going to be the chief income stream. Now, if we think about a residential setting like a single family home or apartment building, you may have other things besides the rent. You may have laundry, coin laundry, maybe in a larger apartment complex. You may have amenities such as a common area that might be rented out for events or receptions and such. Maybe the tenants pay for Wi-Fi or internet or something that provides an income stream, more of an income stream to the investor or the landlord. So amenities like that. And there could be others, but then we subtract the expenses from the income, and that's cash flow. That's really the profit or the income back to the investor, to the landlord, or to the company, to the business. So types of expenses, and this could apply to residential setting, again, single family homes, or to apartment buildings, but it also could apply to a business setting such as a store or an office complex, any type of tenant-landlord relationship. So we have maintenance, and what's that? Whether in a single family home or apartment building type residential setting, or in an office or retail or industrial setting, maintenance could be landscaping, maintenance could be toilets, maintenance could be lighting, light bulbs, maintenance could just be everyday kind of operational things that make the property work. In certain regions, maintenance could be snowfall in the winter, and maybe in most regions, at least cutting grass in the summer. Property management. Property management apply to most of those settings as well, whether it's residential, single family, apartment building, industrial, office building, retail, etc. But someone who's going to perform the property management, maybe take the phone calls if there is maintenance activities that need to take place, maybe take the phone calls if there's questions about the lease, whatever type of lease it is, maybe collect the rent in some sort of fashion, if it's cash rent or if it's electronic payments, but collect the rent, maintaining the relationship with the tenants. All that would be property management. Doesn't mean necessarily you, the investor, need to do it, but someone or something or a firm or a company or a business does need to take on that property management role, and that's an expense. Utilities, I say utilities if any, depending on the lease arrangement, the investor, the landlord, the business may not pay any utilities. Maybe it's the tenant, maybe you pay a portion of them and it's split or shared in some type of way, but in either way, utilities such as electricity, the gas utility, water, all those type of utilities are an expense. Employees or contractors. These could just be employees that are dedicated to the site. Maybe it's a large apartment building and you have a leasing office, someone that's there certain hours of the day. Maybe you have a full-time contractor on staff that stays there. Maybe you just have contractors who perform periodic maintenance activities such as snow removal. That person may not be an employee who does the snow removal. Maybe you contract a company to do snow removal in the winter, and you contract a company to do lawn cutting and landscaping in the milder summer months. So employees or contractors, again, an expense. Insurance, so this would just be like a landlord or owner insurance for the asset, for the property. So you think about fire or liability type insurance if there's something that you just need something to protect the property from those type of things, from fire or hazard, or just like you would on a home that you lived in, that you own or trying to own, or even if you rent, you may have renter's insurance to cover some of the same things. Now, in this landlord or investor-tenant relationship, it's a little bit different because the tenant, and if you do rent, you'll understand the difference. The tenant will have insurance to protect their assets, their property, and the owner, the business, or the investor, the landlord, will have insurance to protect their portion of the asset or the property, which would be everything that belongs to the business or the investor or the landlord, such as the building, maybe the appliances in the building, maybe the different things that belong to the company or the business in the building or in the asset. And anything belonging to the tenant would be covered by the tenant's insurance, assuming they have it. Taxes. Now, we're not talking about IRS taxes. We're not talking about income taxes or sales taxes. We're really talking about property taxes. So the counties, the cities, the municipalities, the states, they charge a property tax. And this is what we're going to get into eventually, breaking down like the cost of these things in the future. But property taxes are a significant expense of the business or of the asset of the property. But it doesn't necessarily matter. You just need your income to cover all these expenses and more, and you're in good shape. Debt. I put an asterisk next to debt because in some formulas or in some discussions or conversations, some people may not include debt as an expense. Just for our starting here, this conversation, this episode, we're going to include debt as an expense because we're talking about your income covering all your expenses related to the asset and then what's left over is cash flow. So debt, what is debt? We've talked about good debt, bad debt. This would be the good debt because this debt is not coming out of your personal pocket. The income from the business or the asset is paying this debt. So this is the debt that you are paying the bank. This would be the form of a mortgage. So remember, you showed up to the investor or to the bank with 25% or 20% or 30%, whatever was agreed upon. And this is the bank paying that other 80 or that 75 or 70%. So you, the business, the income from this asset is paying that debt. So we're going to slot that here as an expense. Don't worry, the income will cover the expenses and more if you do this right. And I'm here to show you how to do this right. So don't be discouraged by looking at it that way, that there's more expenses than income. In fact, don't be discouraged at all. You're here, you're getting the education, you're getting the understanding. Don't be persuaded negatively by someone who is not here understanding the same information the way you are. We all know people who worked in real estate or ventured into real estate in some type of way, probably as a landlord of a home or something like that, and that's fine, but that doesn't equal what you're doing here or what you're learning here. You've seen in the prior show that there are different avenues of real estate to take in all different types of ways. It all depends on what your goals are, and you're leveraging real estate to meet those goals. And that's all I'll say about that. So don't worry, the income will be more than the expenses if you do this right. And you're here, you're learning how to do this right, and you'll be fine. And if you don't want to be bothered with it at all, don't want to get into it, you just want to invest and get your income stream or your return, that's fine too. If you just want to entrust someone else to do that, that's okay too. That's the passive investor. We are certainly happy to do that for you. But even still, I tell investors you still need to at least understand how it works, and you can get that understanding by listening and watching here. Just remember that income minus expenses equals cash flow, and this will be a positive number. So we talked about a lot today: bad debt, good debt, the power of leverage when it comes to real estate. We talked about the math behind all this, and we talked about the first way, or one of the ways, that real estate brings income to you, which is cash flow as you know it now. But that's not the only way. There's more ways that real estate brings you income, and we're going to talk about that in the next show, which is sell or refinance income, which is part of appreciation, mortgage principal pay down, depreciation, and tax benefits. Hey, I hope you enjoyed the show today. Before you leave a comment or ask a question. There was a question that came in that I answered in today's show. I read them all, so if I can make the show better for you, I will. Your question might even end up as a topic for a future show, just like today, or part of a question and answer show in the future. If you want to engage further on bringing real estate investing into your plans, I am at neelyrealty.com/engage. That's NILEE realty.com/engage. Lastly, this show and the next show, it's not just for you, it's for everyone. So share it and pass it along to someone else. And I'll see them and you back here next time as we continue to learn how to build wealth and financial stability through the alternative investment of real estate.
You have been listening to the It's Attainable Real Estate Investing Show, sharing transparent knowledge on investing and the powerful impact real estate investing can have on your wealth and lifestyle. Follow or subscribe to the show using your favorite podcast app so you'll know firsthand when a new show is released, or visit neelyrealty.com/podcast and see the show there. That's NILEE realty.com/podcast.